The log sheets filled the conference table inside the regional office of the Securities and Exchange Commission on the morning of June 15, 2023. Two investigators leaned over the pages, tracing a line of trades that did not match the strategy a Harvard Business School graduate had promised. The documents showed rapid options bets placed minutes after investor money arrived. They also showed gaps. Some entries ended with no collateral attached at all. One agent paused at a set of screenshots that had been sent to early investors. The numbers looked steady, even calm. But the raw brokerage data told a harder story. Risks spiked. Balances shifted in ways that suggested someone was plugging holes with new cash. Across the room, a whiteboard listed the first confirmed victims. All were alumni from the same circle. All believed they were part of something exclusive. The lead investigator looked at the board, then back at the mismatched trades. "Start at the beginning," he said. "Show me how he earned their trust." The story moved backward from there. Chapter 1, the first pitch. The agents started with the earliest records they could find. Those documents showed a name that once carried weight inside an elite network. Vladimir Artamonov graduated from Harvard Business School during a year when the campus hummed with talk about investment strategy and leadership paths. Alumni described him as confident and precise. He often spoke about long-term value and the advantage of patient analysis. Those who knew him in school believed he had a methodical mind. After graduation, he moved into small investment roles. He stayed close to former classmates. Many found themselves in consulting firms, private equity shops, or insurance groups. The alumni circle was tight. People traded contacts and advice. The expectation inside that world was simple. If someone from Harvard vouched for an idea, the idea deserved attention. That culture would become the foundation of what happened next. Early in 2021, Artamonov began sending messages to a handful of classmates. He claimed he had developed a strategy tied to insurance filings linked to large value-oriented companies. He framed it as a method that captured slow shifts in risk absorption. He said it allowed him to make targeted option trades that produced dependable gains. He never said he had direct access to non-public information. He said the filings were complex and underappreciated by most traders. He implied that he alone understood a pattern that others ignored. Several alumni agreed to hear more. They joined short video calls during lunch breaks or after work. He spoke calmly. He used terms that sounded familiar, yet advanced enough to feel specialized. He positioned the strategy as conservative. He emphasized that the options were covered by underlying structures that limited downside. He said he had tested the system for months with his own funds. Those who listened felt reassured. He had the right credentials. He seemed to know the insurance language. He shared slide decks that highlighted smooth lines of performance. He avoided hype. He did not promise overnight returns. He promised dependable growth. For many inside the alumni circle, that was more convincing than bold claims. Within weeks, a few small deposits arrived in his account. They were from former classmates who trusted him. They were cautious at first. They sent amounts that would not hurt them if something went wrong. They asked for performance updates. He sent charts that looked clean. The numbers rose in a steady upward trend. He explained each movement with plausible reasons tied to insurance cycles. The investors nodded along. Investigators later learned that the early months were quiet. The amounts were manageable. The trades were small. The paper trail showed that he made some legitimate moves. But even then, the records hinted at something else. Some trades did not align with the strategy he described. The risk profile was higher. The time windows were tight. It was still early, so these odd trades blended into the noise. Word spread slowly through the alumni community. Someone mentioned him during a small reunion. Another shared his name during a group chat about market volatility. The tone was always the same. He was viewed as a sharp analyst who found a pocket of overlooked opportunity. By midsummer, he had a growing group of people asking questions about how the strategy worked. He stayed patient. He explained it in a way that sounded technical enough to impress, but simple enough to avoid scrutiny. One alumnus asked him about potential downside. The man had been burned by a bad private deal years earlier. Artamonov replied without hesitation. He said the strategy relied on structural inefficiencies, not on timing. He said the risk was spread out and hedged. He said he had never posted a monthly loss since starting. The investor felt reassured. He sent money within the week. By the fall, the pattern was clear. He preferred one-on-one calls. He avoided group presentations. He claimed this was to protect the strategy from misunderstanding. He framed it as a courtesy to investors. Those calls often lasted 20 minutes. He listened closely. He asked about families, career paths, and long-term goals. He made each person feel important. He made each person feel as if they were joining something exclusive. Investigators later reviewed the first complaint that reached regulators. It came from a man who noticed something odd in his account statements. The screenshots looked too clean. The lines were perfect. The gains were never interrupted. He asked for more detail. Artamonov responded with a long explanation that used confident language. The investor accepted it at first, but he saved the emails, he saved the screenshots. Months later, those files became part of the evidence. Inside the Securities and Exchange Commission's office, the agents built a timeline on a long wall. The top row listed early investor names. The second row listed deposit dates. The third row listed trade activity. When they stepped back, they saw something that caught their attention. Many deposits were followed by immediate, large options positions. Those positions were riskier than the strategy described to investors. The investigators debated the meaning of those trades. They asked whether he had modified the strategy. They asked whether the investors had misunderstood. Then they checked his early pitch decks. Those decks promised stability. They promised controlled moves tied to insurance risk cycles. The trades in the logs did not look controlled at all. The trust inside the Harvard alumni world acted like a shield during those early months. Investors reassured each other. They said he was brilliant. They said short-term volatility was expected. They said this was not a common hedge fund. It was a private circle. That belief delayed hard questions. Meanwhile, he continued to collect deposits. Some investors sent money because they believed their classmates were already seeing returns. Some wanted to diversify. Others simply did not want to miss a chance that seemed vetted by people they respected. The alumni connection carried power. Many victims later said they invested because the proposal came from someone with the same background. They thought it meant accountability. During this period, investigators also uncovered an interesting pattern. He preferred to speak about the strategy's philosophy rather than its mechanics. When pressed about specific trades, he shifted the conversation to risk frameworks. When asked about volatility, he highlighted long-term horizons. On the surface, his answers sounded informed. Under scrutiny, they looked incomplete. One evening in late 2021, he held a short meetup at a small restaurant near the campus. A few alumni attended. He spoke about value alignment. He discussed patient capital. He never brought printed materials. He kept everything digital. Several attendees left feeling impressed. They said the strategy made sense. Months later, those same people described that night to investigators. They said nothing seemed off. They said no one could have guessed what was happening behind the scenes. The first signs of imbalance appeared in messages between investors. One man asked another whether he had ever received a detailed statement from the trading platform. The answer was unclear. Most had received only screenshots. Some had received summaries. No one had direct access to real-time records. At the time, this did not alarm them. They believed he managed everything through a central account. Investigators traced the earliest bank transfers and noticed something else. Some investor funds were moved quickly into personal accounts. Others were sent to trading platforms within minutes. A few were routed through intermediate accounts. The pattern was inconsistent. It did not match the presentation of a controlled, methodical strategy. Still, investors continued to trust him. The Harvard name carried weight. Alumni often referred to each other through shared experiences. They used the same language to describe opportunity and leadership. That shared identity made it easier for him to gather support. In early 2022, a new investor asked him whether he could attend a more formal presentation. He declined. He said the strategy did not scale well and needed personal oversight. He said he preferred to keep the circle small. The investor interpreted this as exclusivity. He sent a large deposit in March. When the agents later reviewed the March trades, they saw something striking. The options positions were far larger and riskier than anything described in the pitch materials. The timing showed a pattern of rapid bets placed in short windows. The investigators believed these trades were attempts to recover earlier losses. To build their case, they needed to understand how he grew his network. They read message threads. They examined alumni referrals. They spoke to early victims who described feeling proud to support him. They said they wanted to see someone from their circle succeed. That sentiment made the scheme possible. By summer, the first formal complaint arrived at the Securities and Exchange Commission. The complaint focused on mismatched numbers, slow responses to redemption requests, and vague explanations about risk. The agency began preliminary review. They gathered documents. They interviewed the complainant. They reached out to the financial platform that handled some of the trades. The investigators worked backward from the complaint. They traced the earliest records. They built a model that showed each deposit, trade, and withdrawal. They placed color-coded tags on each item. Blue tags marked investor deposits. Red tags marked high-risk trades. Yellow tags marked inconsistencies in account statements. The board filled up quickly. One day, a junior agent noticed a pattern in the timestamps. Several deposits were followed by identical screenshots sent to investors showing stable values. But the brokerage logs for those exact moments showed volatility. That raised their suspicion. They believed the screenshots were not real-time captures. They believed they were curated or edited. Inside the alumni community, subtle tension began to form. A few investors asked more questions. They wondered why monthly summaries always looked smooth. They wondered why they could not gain direct viewing access to their own positions. Some asked him for more transparency. He responded with calm, long explanations about protecting the strategy from copycats. He said access windows created unnecessary risks. Those answers bought him time. Meanwhile, investigators placed two parallel timelines on the board. One timeline showed the story he told investors. The other showed the actual trades. When they compared the two timelines, the gap was clear. The strategy he described was not the strategy he used. The first chapter of the investigation ended on a quiet Wednesday afternoon. Two agents sat across from each other in the office, surrounded by stacks of printouts. They had enough to confirm that this was no misunderstanding. They believed they were looking at a pattern built on trust, exclusivity, and selective reporting. One agent closed the binder and wrote a single line on a sheet of paper. How far did the money move before anyone noticed? That question set the stage for the next phase, and it pointed to a larger truth. The scheme did not grow because the strategy was brilliant. It grew because the alumni believed the person selling it. They believed the connection meant safety. The investigation was only beginning. Chapter 2: Pressure, Losses, and the Paper Trail. By the time investigators reached the midpoint of the timeline, they saw that the early calm had disappeared. The trading records from late 2021 and early 2022 showed a shift. The positions grew larger. The windows grew tighter. The volatility grew sharper. Each move looked more like a scramble than a plan. The agents spread the documents across a long conference table and traced the pattern again and again. They believed losses had started earlier than any investor knew. To understand why the investors stayed in, the investigators needed to learn who they were. They interviewed the first group of alumni who had trusted him. Many described identical reasons. They knew him from school. They remembered him as stable and analytical. They said he never spoke in exaggerated terms. He spoke in measured sentences. They felt that someone with that personality could not be reckless. One investor described a meeting in April 2022. He had asked for details about how trades were selected. He said Artamonov leaned forward and explained things slowly. He talked about insurance cycles and soft signals buried in public filings. He referenced his own research habits and long nights reading actuarial data. The investor remembered feeling impressed. He believed that the method was complex, but grounded. He believed it required discipline rather than luck. Investigators learned that this investor had trusted too easily. They found no evidence of deep research habits inside the digital records. They found no sign of sophisticated modeling tools. They found no spreadsheets built around insurance filings. Instead, they found trading windows that opened minutes after deposits arrived. The pattern looked reactive. The victims described other reasons they felt safe. Many said they trusted the alumni network. They said they had worked on projects with fellow graduates in the past. They said those experiences built confidence. The shared identity created a sense of protection. Several victims said they would never have invested if a stranger had pitched the same idea. They believed the Harvard connection reduced the chance of fraud. Investigators listened carefully. They saw how affinity played a role. They wrote notes that highlighted the psychological patterns. But they did not rely on impressions. They needed hard data. They wanted to prove the movement of funds. They therefore focused on bank logs and trading statements. The documents showed a clear escalation. In early 2022, multiple investors requested small redemptions. These requests triggered a series of transfers that exposed a larger problem. Instead of using existing balances to pay out those redemptions, the logs showed that he moved money from new investors into the accounts used to cover the requests. The agents circled those entries. They labeled them with red tape. They believed they were seeing early examples of using new funds to fill old obligations. The pattern repeated again in June 2022. A large investor asked for a partial redemption. The response came quickly. The investor received a payment within 2 days. But the investigators later discovered that the funds used for this redemption came from deposits made by two completely different investors. The trading account at the time showed negative exposure. The redemption did not come from profit. It came from new cash. The agents created a flow chart to show the connections. The chart revealed that the money moved through multiple accounts. Some were personal, some were labeled as trading platforms. A few were routed through smaller financial firms that offered quick transfers. The movement was not illegal by itself, but when the agents compared the path to the promises he made, the mismatch grew obvious. Meanwhile, the victims continued to receive updates. Many said the updates looked polished. The charts were smooth. The language sounded professional. The statements never showed losses. They always showed a steady upward slope. These statements became a key part of the investigators' work. They wanted to know how the numbers were produced. They compared the statements to the raw data. They noticed that the statements lacked certain details that should have been present if they were generated directly from a brokerage account. One agent focused on the metadata of the files. He discovered inconsistencies in the timestamps. Some statements claimed to reflect end-of-month values, yet the files were created earlier. Others showed performance periods that did not match the actual trading records. This supported the theory that the statements were generated manually. Inside the alumni circle, the trust began to crack. A few investors started sharing concerns with each other. They questioned why redemptions took longer than expected. They noticed delays in responses. They asked for more access to real-time performance data. He responded with long explanations. He said the trading platform limited external viewing. He said he needed to protect the strategy from being copied by larger funds. He said that exposing positions during open trades created unnecessary risk. These answers worked for a while, but the pressure increased. A key moment occurred in August 2022. An investor who had placed a substantial amount early in the strategy asked for a full redemption. He said he needed the funds for a family expense. The request was not unusual, but the trading account at the time showed a major deficit. Investigators later confirmed that the account had been hit by several losing options bets. The losses were large enough to wipe out earlier gains. The next series of transfers painted the clearest picture yet. The funds to cover the redemption did not exist in any of the investment accounts. Instead, the investigators tracked the money to deposits made by 3 new investors. Those deposits arrived in a tight cluster. They were then transferred immediately into the account used to pay the redemption. The agents marked the transfer as a pivotal point. It illustrated a core feature of the scheme. Without new money, the old obligations could not be met. The victims described their interactions during this period. Some said he became more responsive when they had concerns. Others said he reassured them with detailed explanations. One investor recalled a 40-minute call in which he repeated the same phrase. He said the market volatility was temporary. He said he had contingency plans. He said all positions were hedged. The investor later learned that the trades during that period were not hedged at all. Inside the Securities and Exchange Commission office, the agents continued to build the case. They interviewed analysts who explained how options strategies normally worked. They clarified what a hedged position should look like. They compared that to the positions in his account. They found no evidence of consistent hedging. The trades looked like speculative bets. The agents also examined communication patterns. They found that he often responded to redemptions late at night. They compared the timing to deposit logs. They noticed that his availability tended to increase when new money arrived. They believed he was monitoring inflow closely. One investigator created a timeline with 3 vertical columns. The first column tracked investor communications. The second tracked deposit activity. The third tracked trades. When the lines in all columns were aligned, the story became clear. Deposits arrived, large trades were placed, losses occurred, new deposits arrived, redemptions were paid. The cycle continued. The investigators brought in a digital forensics specialist to review the screenshots sent to investors. The specialist examined pixel patterns and visual artifacts. He concluded that some screenshots had been altered. He said they did not match the formatting of the trading platform used by the account. He pointed out small inconsistencies in font alignment and spacing. These inconsistencies suggested manipulation. During this time, the investors continued to talk among themselves. One man shared concerns with a former classmate. He said he felt uneasy about the lack of direct access to his account. The classmate responded by saying that the man had always been cautious and should trust the process. Another investor expressed concern about the rapid shifts in communication style. He said that sometimes responses were fast and clear, while other times they were slow and vague. These mixed signals raised questions, but not enough to trigger a formal complaint. The agents interviewed these individuals. They asked about their impressions. They asked about their conversations. They asked about their memories of the early presentations. Many said they felt embarrassed. They said they were surprised they had not asked harder questions. They said the Harvard connection made them comfortable. The investigators continued to build their financial analysis. They looked at statements from 2 banks that handled most of the transfers. They identified repeated patterns. Money from one investor would arrive in account A. Within hours, that money would be transferred to account B. From there, the funds would be used to cover redemptions or losses in a trading platform. Sometimes the same path reversed. Money from a platform would be wired into a personal account before returning to an investment account. These movements were inconsistent with a controlled investment strategy. To understand the full scale of the issue, the agents needed more detail. They reached out to additional alumni victims. Some were reluctant to talk. They felt ashamed. They said they trusted him because he was one of them. They said the losses felt personal. One investor from the class of 2010 described her experience. She said she had believed he was transparent. She said he always spoke calmly. She said she trusted him because they had shared mentors. Investigators showed her the raw trading logs. She looked at the losses. Her face tightened. She said she did not know any of this. She said she felt misled. Another investor described a conversation in late 2022. He said he asked about the sudden volatility in the market. He said Artamonov told him the strategy was insulated from broader swings. He said options were chosen based on deep structural models. The investor later learned that the positions taken that month were among the riskiest in the account's history. As the timeline neared its midpoint, the investigators saw a clear escalation. The strategy being pitched and the strategy being executed were completely different. The promised method was stable. The actual method was unstable. The promised risk profile was conservative. The actual risk profile was aggressive. The promised structure relied on insurance patterns. The actual structure relied on short-term options bets. The agents prepared a memorandum that highlighted the discrepancies. They summarized the evidence. They stated that investors had been misled. They also stated that the movement of funds suggested a pattern consistent with a Ponzi-style structure, but they needed a break. They needed proof that connected each part of the structure to a deliberate pattern. That break came when they compared two sets of documents that had been overlooked earlier. The first set consisted of the investor statements. The second set consisted of the exact deposit and trade logs. When chronologically aligned, the contrast became undeniable. The statements always showed smooth performance. The raw logs showed extreme swings. Some days had losses large enough to wipe out months of claimed gains. These losses were never reported. The investigators pressed deeper. They reviewed emails. They found that some messages contained repeated phrases. He often said that positions were protected by hedges, but the trading logs showed no protective positions. They found that he said the strategy used insurance data, but the logs showed no relationship to insurance cycles. The strategy in practice looked like unmanaged speculation. One evening, an agent noticed a cluster of transfers that occurred within hours of each other. The investor who received a redemption that week had asked for his funds due to a medical issue in the family. The agent followed the path of the money. He discovered that the redemption came from 3 separate new deposits. Those deposits arrived within one day. He marked the flow as a critical connection. It demonstrated that redemptions were dependent on new money. The agents continued their analysis. They reviewed documents from a financial firm that had processed some transfers. They learned that multiple wire transfers had been flagged for manual review because of inconsistent descriptions. Some wires were labeled as investments. Others were labeled as personal income. The inconsistencies raised questions about the true purpose of each transfer. As pressure increased, he became more active in communication. Victims said he sent more updates during this period. Some said he seemed anxious. Others said he seemed distracted. One investor said he sounded tired and hurried one night. He said he was dealing with a sudden issue in the market. He said he needed more time to adjust positions. The investor accepted the explanation. Later, he said he wished he had recognized the warning signs. Investigators compared these communications to the trading timeline. They noticed a connection. The messages about market issues aligned with the largest losses in the account. The messages about long-term stability aligned with periods in which he needed new deposits. In the late months of 2022, some investors pushed harder. They asked for transparency. They asked for proof of positions. They said the lack of direct access concerned them. He responded with carefully written messages. He said he would provide more details soon. He said he was preparing new reporting tools. He said he needed to finalize some administrative steps. These promises never materialized. Inside the agency, the agents prepared a case summary for their supervisors. They outlined the findings, they described the victims, they explained the affinity path. They said that the case required deeper investigation. They asked for authority to pursue additional records. The investors who had remained quiet found themselves talking more openly. They wondered why redemption times varied. They wondered why statements looked perfect. They wondered why he always controlled access. These questions built tension inside the alumni circle. During this time, the investigators discovered something significant. They found a set of transactions that moved through a small financial service platform. The transfers were processed quickly and involved money from 3 separate investors. The platform flagged one transaction for review because the description changed mid-process. This raised suspicion. It suggested an attempt to mask the true purpose of the funds. In the final weeks before the investigation reached a turning point, a large investor demanded a full accounting of all positions. This request marked a major pressure point. He delayed, he explained, he stalled, he said the accounting would be ready soon. The investor pressed harder. He said he needed proof. The tone of the messages shifted. The trust began to erode. The agents monitored these developments. They continued to map each movement of funds. They saw that the pressure from redemptions forced him to seek more deposits. They saw that desperation increased. They saw that the scheme was reaching a stress point. On a cold evening in December 2022, the agents gathered around the whiteboard. They had spent months building the story. The pattern was clear. Money from new investors was used to pay earlier investors. Trades were inconsistent with the promised strategy. Statements were altered. Communications were misleading. The structure was unstable. One agent pointed to a series of overlapping arrows on the board. He traced the lines with his finger. He said these arrows showed the tipping point. He said the scheme could no longer sustain the pressure. The investigators looked at each other. They agreed that the case now showed a clear pattern. They agreed that the next step was critical. They needed a break that would shift the investigation from suspicion to confirmation. That break was coming. It would arrive when they connected the timestamps of deposits to the moment he patched deficits in the account. The pressure had reached its peak. The cycle could not continue. The agents prepared for the next phase. And the story continued toward collapse. Chapter 3: The Break and the Collapse. The breakthrough came on a quiet morning in January 2023. Two investigators sat in front of a wide monitor with spreadsheets covering the entire screen. They had spent weeks trying to align the timestamps from deposit records with the timestamps from the trading account. They believed the connection would expose the structure beneath the scheme. Now, as they scrolled through another row of transactions, the link they needed appeared in front of them. A deposit from one investor arrived at 9:18 a.m. on April 27, 2022. 4 minutes later, the trading account showed a large options purchase. The position was too large to have been placed without the deposit. The investigators checked 3 more entries from the same week. The pattern held. New deposits triggered new trades. Those trades attempted to fill previous losses. The agents marked the entries with a bright stripe of tape. These links formed the core of their case. They continued the review and saw the same pattern across weeks and months. A series of deposits arrived during the summer. Each deposit was followed by immediate trades that carried high volatility. These trades did not match the promised strategy. They looked like attempts to recover lost ground. The investigators placed these findings in a timeline. The timeline told a clear story. He was using new investor funds to fill gaps caused by earlier losses. With this connection established, the team prepared a detailed report. The document outlined the money flow from one investor to the next. It showed how redemptions were funded by new deposits. It showed the absence of profit generation. It showed how statements were altered. It showed how communications were structured to delay suspicion. The report was long and precise. It formed the foundation for the next step. Regulators authorized a deeper investigation. They obtained warrants for financial records, digital correspondence, and trading platform data. The agents moved quickly. They did not want the subject to move funds or delete records. They coordinated with federal partners. They prepared a plan to seize devices and secure accounts before more money shifted. The operation took place on a cold morning in February 2023. Agents arrived at his residence. They knocked, identified themselves, and served the warrant. He opened the door with a calm expression. He asked what this was about. The lead agent handed him the paperwork and explained the purpose of the search. He stood still for several seconds, then nodded. Inside the residence, agents collected devices. They gathered laptops, hard drives, and mobile phones. They collected printed documents. They located notebooks containing trading ideas and handwritten calculations. They photographed the workspace. They copied data from routers and cloud accounts. They secured email records. The process took hours. While some agents worked inside the house, others visited a small office he used for meetings. They took financial binders and receipts. They located printed investor lists. They seized a box of documents that appeared to contain draft statements. They collected a large monitor that displayed a spreadsheet labeled Performance Master. They captured each sheet inside the file. They noted that some sheets showed losses while others showed gains. The discrepancies raised questions about which versions had been given to investors. At the same time, another team visited 2 financial firms that handled many of the transfers. The firms cooperated fully. They provided wire logs, account notes, and internal flags. They confirmed that multiple transactions had been flagged for unusual descriptors. They provided statements from the investment accounts. They explained how each transfer moved through their systems. These details became crucial evidence. Back at the agency, the digital forensics specialists began examining the seized devices. They recovered deleted messages, drafts of statements, and screenshots that appeared to be templates for investor updates. They also recovered raw trading logs that matched the records from the brokerage platform. These logs showed the scale of the losses. They also showed that the account had been nearly depleted during several periods. The investigators found a folder on one device labeled Notes. The folder contained text files in which he tracked redemptions and new deposits. One file contained a list titled Urgent Requests. Another listed names of investors he believed would send new funds soon. The agents reviewed these lists carefully. They concluded that he had been trying to time redemptions with anticipated new deposits. This supported the theory that the structure depended on constant inflow. Meanwhile, victims began learning about the investigation. Some received calls from the agency. Others learned through alumni groups. Many felt shock. They said they had believed the strategy was real. Some said they had spoken with him days before the search. They described him as calm. They said he never hinted at trouble. Investigators began conducting detailed interviews. They asked each victim about their experience. They asked about communication style. They asked about the promises made. They asked about the timeline of deposits and withdrawals. The victims provided messages, screenshots, and statements they had saved. These materials confirmed the pattern. The statements showed steady growth. The messages showed reassurance. None of the materials revealed the losses hidden behind the scenes. The agents organized the evidence into a large chart. The chart covered an entire wall. It showed each victim, their deposit date, the trade activity around that time, and any redemptions made. It also showed how funds from later investors were used to pay earlier ones. The chart looked like a web. Arrows crisscrossed and overlapped. At the center of the web was the trading account controlled by him. After weeks of analysis, the investigators were ready to confront him. They scheduled an interview. They explained that he was not required to attend. He chose to come. He arrived with a small notebook and a quiet demeanor. He sat down across from two agents. They read him his rights. They began asking questions. The early questions focused on his background. He discussed his education, his work history, and his interest in insurance patterns. He spoke calmly and at length. The agents listened. They wrote brief notes. They then shifted to the trading strategy. They asked him to describe how he selected positions. He explained that he used a model based on public filings. He said the model indicated when risk absorption shifted. He said the model guided his trades. The agents then compared his statements to the raw logs. They pointed out trades that did not match the model. They pointed out large options bets that carried extreme volatility. He said those trades were anomalies. He said they were experiments. He said they were temporary adjustments. The investigators continued to press. They showed him the pattern of deposits followed by immediate trades. They showed him the timestamps. They asked how the model explained those moves. He paused. He said the model required immediate execution when signals appeared. The investigators continued their questions. They asked why redemptions were funded by new deposits. They asked why statements were altered. They asked why screenshots did not match the platform. His answers grew shorter. He said he had been under pressure. He said he tried to manage timing issues. He said he intended to fix the problems. The agents noted these statements. They later added them to the case file. After the interview, the investigators reviewed everything gathered so far. They believed the evidence showed a clear structure in which new deposits covered earlier obligations. They believed the statements sent to investors were misleading. They believed the trading logs showed consistent losses. They believed the pattern formed a Ponzi-style scheme. Regulators prepared formal charges. They presented the case to federal prosecutors. The prosecutors reviewed the evidence. They examined the money flows. They examined the trading logs. They examined the communications. They concluded that the structure met the criteria for fraud. They moved forward. The charges were filed in the spring of 2023. They included wire fraud, securities fraud, and related violations. Each charge reflected a piece of the structure. The indictment detailed how investor money had been used. It described the false statements. It described the use of new funds to pay old investors. It described the risks concealed behind the strategy. News of the charges spread through the alumni community. Many victims learned the details for the first time. Some said they had suspected trouble. Others said they were blindsided. Some said they felt betrayed by someone they trusted. Others said they felt angry at themselves. The emotional weight varied, but the sense of collective disappointment was strong. During the early hearings, the prosecutors outlined the pattern of misleading statements and misused funds. They showed charts that illustrated the cycle. They highlighted how deposits from one investor were routed to pay redemptions for another. They described the gap between the promised strategy and the actual trades. Defense counsel argued that he had intended to build a legitimate strategy. They said the losses were unexpected. They said he had tried to recover. The court listened carefully. At the same time, investigators continued to support victims. They explained the recovery process. They clarified what funds could be traced. They said that some assets might be recovered through forfeiture. They said recovery would take time. The victims asked questions about the timeline. They asked about next steps. They asked whether they might regain their money. The answers were cautious. The agents studied the aftermath closely. They saw the impact on investors. Some had lost savings. Others had lost funds intended for long-term goals. Many felt a deep sense of trust broken. The shared identity within the alumni community had been manipulated. The betrayal cut deeper because it was personal. Federal prosecutors prepared the sentencing memorandum. They described the losses. They described the scope. They described the pattern of deception. They emphasized the trust taken advantage of. They asked the court to consider the harm. The defense argued for leniency. They said he had no prior record. They said he had contributed positively in the past. They said he had acted under pressure. The judge weighed both sides. During the sentencing hearing, the victims had the chance to speak. Several described their experience. One said he felt embarrassed for not seeing the signals. Another said she believed in the Harvard bond and felt it had been weaponized. Another said she lost confidence in trusting professional peers. The court listened quietly. The judge thanked each person for their testimony. When it was his turn to speak, he stood and faced the judge. He said he was sorry. He said he had not intended to cause harm. He said he made mistakes. He did not provide details about the scheme. He did not explain the decisions behind each transfer. He spoke in general terms. The judge noted this in the record. The court delivered the sentence later that afternoon. The sentence reflected the scope of the fraud and the harm caused. It also reflected the importance of accountability in financial crimes. The judge explained that such schemes erode trust within communities. He said the consequences must be clear. After sentencing, the focus shifted to recovery. The government sought forfeiture of assets. They traced remaining funds. They worked with financial institutions to return money where possible. Some victims received partial recovery. Others received none. The process continued for months. The agents reflected on the case. They discussed how affinity fraud can take hold. They noted that shared identity can create vulnerability. They said that people trust those who share their background. They said that education and community ties can become tools for deception when misused. They emphasized the importance of skepticism and independent verification. The alumni community also reflected. Many said they no longer viewed investment opportunities the same way. Some said they would never again invest without direct access to records. Others said they would be more careful about referrals. They said the experience changed their understanding of trust. Investigators compiled a final report summarizing the entire case. The report highlighted the pattern of deposits and withdrawals. It documented the steps he took to delay detection. It detailed how statements were altered. It described how trades were inconsistent with the pitch. It concluded that the scheme relied on constant inflow and collapsed under pressure. As the report circulated through regulatory and academic circles, analysts noted the broader lesson. The case showed how affinity networks, when misused, can amplify risk. They said that strong communities can become blind spots. They said that fraud does not always come from strangers. Sometimes it comes from those who share our identity. Months later, during a quiet afternoon in the regional office, One of the lead investigators stood in front of the timeline board. The colored lines and arrows still covered the wall. He traced the path of the first deposit. He followed it through the cycles of transfers, trades, losses, and redemptions. He paused at the point where the structure began to crack. He reflected on how simple trust can be redirected into harm. He stepped back and looked at the entire board. He saw the rise, the pressure, and the collapse. He saw the cost. He saw the lesson left behind. The case was closed, but its impact continued. Inside the alumni community, conversations changed. People asked harder questions. They reviewed documents more carefully. They no longer assumed that shared identity meant safety. They learned that trust must be supported by evidence. The investigators closed their files. They updated their records. They prepared for the next case. They knew that affinity fraud would appear again somewhere else. They also knew that each case carried a unique shape. They understood that the damage done in this case would echo for years. The story ended with a reflection on accountability. Fraud thrives where scrutiny fades. Trust must be earned. Oversight must be consistent. Systems exist to protect investors, but those systems rely on people asking questions. The case of Vladimir Artamonov revealed a truth that applies far beyond one alumni network. Trust without verification carries risk. Communities built on shared experience must remain vigilant. The collapse of the scheme left a clear message. Transparency matters, accountability matters, and even in circles built on achievement and reputation, harm can arise when oversight falters. In the end, the investigators saw their work not only as accountability for a single case, but as a reminder that financial trust must be supported by clarity, evidence, and independent review. The cost of ignoring these principles had been written across the timelines, charts, and testimony gathered over months. The case closed, but the lesson remained strong. That lesson echoed through every interview and every statement. Trust is powerful. Misused trust is dangerous. And when trust is exploited inside close circles, the damage extends far beyond money. The story of the Harvard network and the scheme that collapsed within it stood as a reminder that even the most educated and connected communities must stay alert. The investigators turned off the lights, left the office, and prepared for the next investigation. But the board on the wall, with its colored lines and arrows, remained as a silent warning about how easily trust can be reshaped into something harmful when transparency disappears. And that warning would guide many who read the report in the years that followed.